Coca-Cola stock is down 5.5% over the last 12 months, and we can also see it has been given a buy rating by both Seeking Alpha analysts and Wall Street analysts, with quant analysts indicating it a very strong buy now. So is it undervalued? Do we need to consider this for the portfolio? As always, we'll do the deep dive. We're going to look at their revenue growth over the last few years, as well as their bottom line net income. We're also going to assess the health of this company, analysing their total cash versus their total debt. And we want to see how well they are performing versus others in their industry, looking at competitors over the last 10 years. We're also going to take a look at the important dividend safety, take a look at dividend yield theory, look at some of their growing metrics like the free cash flow, the net debt to EBITDA. And as always, we're going to look at both insider ownership, any insider buys, any insider sells, as well as the same, replicate that, but for institutions. And we also want to point out a few really interesting things that we have noted from their latest investor presentation, as well as some other news articles that are quite important. As always, we're going to run it through the valuation model to get to the intrinsic value, as well as our acceptable buy price, given that investor margin of safety, and look towards Wall Street to see what they're forecasting for the next 12 months. So let's jump straight into the historical performance. Now we can see they are down around 5.5% over the last 12 months. In fact, year to date, pretty much flat. And when we extend this to the last 5 years, up 27%, and over the last 10 years, up 54%. Whilst this doesn't include those dividends reinvested, not the greatest return on any investment over that period. So let's find out if the story is different if we are looking to invest today for 10 years and beyond. Well, currently we do see it sitting in the midpoint of the 52-week range. It does offer a yield of 3.27% and has a forward PE just over 21. Now, when we analyze companies and we look at their financial statements, one of the things we want to see is growing revenue year on year. What we're looking for is 3 to 7%, and what we can see, December 2014, they reported 46 billion on their top line. December 2023, so we are talking about 10 years later, they reported pretty much a very, very similar figure. So when we look at it in graph format, we can in fact see that their top line did decrease over the last 10 years before increasing. And when we look at it from a singular point, really the numbers have not changed from 2014 to 2023. So something for us to consider, and we will take that through to the next phase when we look at our valuation and margin of safety. One thing we do want to point out here is if you were to factor inflation of around 4% year on year, they probably haven't been increasing their top line. So let's consider that later on. In terms of bottom line, a different story. However, we do see around 7 billion reported in December 2014, 10.7 billion in their latest annual accounts. So they have been increasing their bottom line, but again, pretty inconsistently, although over the longer period, it is moving in the right direction. So whilst their top line revenue does look fairly stagnant, we do see they are increasing their bottom line net income. Quick look at the health check of the company, total cash and short-term investments versus total debt. So we see this sit around 22 billion in 2014. Latest quarterly report, they do hold just under 14 billion worth of cash, so a little bit less, and we can in fact note their cash position over the last 10 years has been decreasing. It's not necessarily a red flag indicator, just something that we will take a look at when we compare against their total debt. And we can see their total debt in fact has gone from around 42 billion in 2014 to around 44.5 in their latest quarterly report. So cash has been decreasing whilst their total debt has been increasing slightly. Not the greatest thing you want to see, but again, it is important to factor this in, and it will be interesting when we look at their dividend safety and their net debt to EBITDA metrics. Now, competitors in the industry, in the soft drinks and non-alcoholic beverages, we have the popular PepsiCo, Monster Beverage, Dr. Pepper, and a few others. Now, over the last year, including dividends reinvested, we do see Coca-Cola in the middle performing. You would be still down, however, at negative 2.5%, slightly better than performance than PepsiCo, which was down 5%. When we extend this over the last 5 years, we again see Coca-Cola as one of the mid-performing, although they did come second to Pepsi at 59.43%. And over the last 10 years, we do note there are again, pretty much when you expand over the longer term, they are one of the mid-performings in the industry. But one of the common themes here is that PepsiCo does tend to outperform Coca-Cola, which will be interesting when we come to look at our valuation to see what level of upside and margin of safety we do get from this company. In terms of their growth rate and some of their metrics, well, they got an overall C+ grade. When we do take a look at their growth year-on-year top line, 6.4%, that is better than the sector median of 3.3%. Forward looking, however, they are expected to come in just shy of the sector median of 4.07. And when we do take a look at other growth rates like the EBITDA year on year as well as the forward looking, we do see it is not too far off the sector median. The same can be said for the EBIT growth as well. However, they're not going to outperform the industry over the next year based on these metrics. And we do note they're not good enough to get higher than a C+. So let's take a look at this. When we look at their investor presentation, there are a few things we do want to point out from that. Now, profitability, however, a much better score, A+. Gross profit margin, very high, 60%, significantly higher than the sector median at 34.73%. EBIT margin, significantly higher at 29%. And the same can be said for their net income, their bottom line margin. So very, very strong, very, very good in terms of that profitability, not just in terms of an isolation, but also when we do compare it to the sector median, the industry leaders in this entity. Now, let's take a look at essentially the insider ownership. It is just below 1% at 0.97. We do know about 89 million worth of sales by the institutions over the last 12 months, and it is something that we can consistently see quarter on quarter over the last few quarters. Now, in terms of who they are, well, we can see, in fact, the EVP in the middle of March did sell over 57,000 shares for a total of around 3.5 million. And we do see another insider sell, in fact, at the beginning of March for just over $1 million. So there is a fair amount of selling on a consistent basis that we do note. Interesting to see, but in my personal opinion, it isn't anything that is bearish to flag, as we never really know why insiders sell, whether it's personal or financial reasons. However, on the flip side, if we do ever see insider buying, that is a very bullish signal, given the fact that insiders do buy because they believe the share price will go up. Now, institution ownership does sit at 70%. We do see around 10 billion or 10.83, in fact, of sales by these institutions over the last 12 months, but we see a significant amount more during the same period. So not only do we see more over the last 12 months, but in the more recent quarter in Q4 of 2023, and when we take a look at Q1, we do see the opposite sign. So lots of interesting things here to note. Whilst over the last 12 months, institutions are buying more shares as well as Q4 of 2023, we do in fact see that in Q1, whilst we don't have the full data set available, there was more selling, 80 million versus 4.63. But as always, do your own due diligence and never solely rely on what institutions or what insiders do when you are getting to your own investment thesis. Now, few things that we do want to point out from their latest investor presentation are the different strategies as well as the growth rates expected for the different industries that they operate in. So the first one is that we have coffee. They expect this industry to grow at 5 to 6%. When we take a look at the emerging markets, we can in fact see 6 to 8% here. We can see some of their experimental products, 8 in fact, with over 1 billion worth of retail sales. And the one with the highest is going to be that energy drink, around 8 to 9%. And we can see here that is their relationship that they do have, in fact, the equity that they hold within Monster Energy, and that is up 5 times since their acquisition. It is quite interesting to note as well that they hold some of that Monster equity within their company, whereas when you take a look at PepsiCo, they do hold some Celsius. Now, what I find is quite interesting from here, again, do not expect massive growth with Coca-Cola. Just, in fact, the industries that they do operate in, they are looking at mid to high single-digit growth. Now, when we take a look at their forward guidance, again, that is something that we can see from here. They're expecting mid-digit organic revenue, 6 to 7%. Earnings per share 4 to 5%, and free cash flow around 9.2 billion. And we can take a look at the historical free cash flow as part of our valuation. So do bear in mind, Coca-Cola, it isn't a company that is going to be growing at a very fast rate. However, it is very consistent year on year based on what they're expecting for FY24 and beyond. One thing as well that we did find quite interesting is that they are looking to invest 165 million in 2 factories in Uzbekistan. Again, this was only just released yesterday, so some interesting information. And on top of that, they are also looking at doing a very strong campaign, a marketing campaign, in fact, where they are combining with Marvel as well. So Coca-Cola, even though it is one of the most recognizable brands in the world, they do not stop their marketing. As I'm sure you're aware, when you do turn on the TV, you are probably seeing a lot of their adverts, and this is one that you should expect to see on your screens very, very soon. Also, just to let you know, we have released our latest free weekly article. If you do want to gain access to this, we have gone through 10 undervalued stocks for your portfolio, completely free. Do click on the pinned comment below. You will have instant access to all of these other articles as well. Now, in terms of their dividend safety, we have a score of 80. It does look to be safe. Market cap 256 billion. They are a mega cap company. Now, in terms of their last recession, well, the metrics from that is they in fact increased the dividend during the 07-09 crash. They had above average growth, -5% versus the S&P's -12%, and they did significantly outperform the S&P, -31%, with the S&P coming in at -55%. Dividend growth now. On this channel, what we always advocate is a minimum of 4%, whether that's your dividends, your salary, your other income producing assets. The reason for this, the US inflation rate over the last 40 years was 4%. Anything less, you're not just getting a pay cut, but you're also losing your purchasing power. So to get 5.4% was fairly nice, but again, do bear in mind with Coca-Cola, they're not going to be offering large double-digit growth that you would see in other dividend growth companies like Visa, MasterCard, etc. Over the last 5 years, they would have essentially been doing it at a lower rate than inflation at 3%. However, over the last 20 years, on average, at 7%. What is interesting is not only are they a dividend king, they have increased those dividends for 50 years or more, but they have been paying a dividend for the last 104 years without a reduction. Now, taking a look at dividend yield theory, for those that are new, it states a company is undervalued when the current yield sits above the 5-year average. Today's episode, we have a double undervaluation signal for Coca-Cola. Not only is the yield above the 5-year average, but the forward PE sits below the rolling of 24.2, and it is fairly in line with the consumer staples. But again, do remember we're not looking at any of these models in isolation, and we will conclude towards the end. Free cash flow payout, that is what we draw your attention to, as earnings is susceptible to manipulation by management through accounting. Below 70% is what we advise for consumer staples if you want to be industry specific. Personally though, I do like to see around 60% as an ideal point. Now, 80%, 82% over the last 2 years, expected to go higher to 86% in FY24. This is one of the reasons why we always say don't expect large dividend growth from this company. They already pay out a significant amount of their free cash flow as dividends. Free cash flow per share growth, though, we do see it increasing over the longer term, although we do note it is very inconsistent. And in fact, if you'd bought in 2014 and sold in 2017, you probably wouldn't be blamed. And you can see, in fact, their free cash flow has been decreasing. Since then, though, it has rebounded very strongly. But as we mentioned, free cash flow isn't really expected to grow. And in terms of the earnings per share, we are only looking at a few percentage points. In terms of sales growth, well, again, 3 to 7% steady moderate growth. As we already ran through, we showed you their revenues hasn't really shown much growth over the longer term. In fact, we see here 6 years of the last 10 negative growth, with only 4 showing positive growth. And we can see what we showed you earlier, but in a different format. In terms of shares outstanding, though, typically return excess cash through share buybacks, as we can see very minimal amounts year on year. So don't expect this if you are an investor or a potential investor. ROIC, nice to note, it has been increasing and was already fairly strong at 14% in 2014 and 15, 17, 18% over the last 2 years. Attractive to investors as it does show us how management are effectively able to allocate their capital. Margins, very strong. Operating side, we see operating efficiency with it growing over the longer term to 29% over the last 2 years. Free cash flow margin well above the minimum 7%, and it has been increasing as well. Low 20s over the last 2 years. Very impressive to note. Now, net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. Whilst we did say earlier that cash has been decreasing while debt has also been increasing, it isn't something necessarily you want to see, but this does show us there are no worries with the dividend as it correlates to both dividend safety and balance sheet strength. Below 4 for consumer staples, in fact 1.99 expected in 2024, so we see nothing to worry about with this company. No real red flag either when we have just done our review. So as always, let's jump into the valuation. If you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So the first model we're taking a look at is the multiples valuation model, companies in a similar sector and size. We have their P, average P, multiplied by the EPS of Coca-Cola, and we get an undervaluation signal with the intrinsic value sitting above the market price. Now, in terms of the dividend discount model, the second model, we have the average growth rate sitting around 4%. However, the more recent increase was over 5%. So on average, Forward looking, we are going for 5%. You could argue it is a little bit optimistic, but we do believe they will start to increase it by around this weight moving forwards. Again, we get a second undervaluation signal with an intrinsic value not too far off from that of the previous model. We then move on to the DCF model where we have the free cash flow year on year. 4% increase over the last 10 years. Now, forward looking, we've gone for 10% in line with analyst targets and what management expect. In conjunction with the discount rate, we get the present value of future free cash flow and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get to our intrinsic value. So we have 3 undervaluation signals in today's episode, and they all pretty much are around the same price. Don't forget you can grab a copy of this valuation model so you can get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or even those on your watch list. So we have an intrinsic value of $67. As always, we do use a margin of safety of 10% to start off with, and we execute if it meets the 3 golden criteria. So these golden criteria are first a strong moat, strong financial metrics, and good forward-looking data. At 10%, it is pretty much around the current trading price. For it to hit 15%, it would need to be around $57 or $57.50. So for today's episode, we do see around 10 to 15% of the MOS level based on our estimates and judgments for the company ticker symbol KO. In terms of Wall Street and their forecast, well, they have a price target slightly higher than our intrinsic value at $70. And they see some strong double-digit growth, 19% target as well. And as we did go through at the beginning of the episode, both Wall Street and Seeking Alpha targets, and in fact, quant analysts do believe this is a buy now for investors. However, as always, do let us know your thoughts in the comments below. Is this one you're adding to? Maybe it's one you've held on for a long time and you're considering selling, or maybe it's purely just on the watch list. For me, this is going to be a stable, consistent company. You kind of know what you're going to get. You're going to get the 3 to 4 to 5% increases year on year to the dividend. Over the longer term, though, you're not going to get anything that is really strong when you compare it to other companies like in the tech industry, but you are going to get that consistency and stability that a lot of investors do appreciate. As always, though, do drop your thoughts below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.